G. Chokkalingam, ED and CIO at Centrum Wealth Management, joins in to talk about the fundamentals of the market and this edition of Street View. Chokkalingam, hi, afternoon. Do you think anything material can come out after the Prime Minister has taken over the finance portfolio and he's meeting today with C. Rangarajan as well as Montek Singh Ahluwalia? And can we see any conclusive reforms from New Delhi either before or soon after the presidential elections?
I think there is no choice left to them. I mean, it's out of compulsion they have to do for three reasons. One, the rupee has crashed by more than 27% year on year. And our monsoon is also testing our patience. And the last 26 days, only 5 days we had a normal monsoon. The remaining 21 days, it was quite pathetic. And also the rating agencies have already given the threat. So I firmly believe that the new finance minister has no choice and he has to do something to prop up the economy and also prop up the rupee. Then only we can realize the gain of recent crash in the oil price. So I still remain hopeful. On the other hand, I remain a little concerned about a monsoon. However, we firmly believe that it is too early to press any panic button on monsoon front.
So in the medium term, do you think the bias will continue to remain negative, or do you think that there is a possibility of enough triggers that could take the markets higher from these levels?
We firmly believe that there are enough triggers. As I said, there could be FDI in multi-brand retail through executive order, and post-presidential election with the help of BSP and SP, there is a possibility of passing three core economic bills like banking, insurance and pension. The fact is that the Samajwadi Party and the BSP together have got a good number of seats in the Rajya Sabha. So with the help of these parties, the present government has majority, which will help them to pass all the core bills even in the Rajya Sabha, which is very crucial. So we remain quite optimistic. And as I said, the only concern would be on monsoon.
So Chokkalingam, what is it that you're advising your clients to either buy or sell? Would you have any stock-specific recommendations?
We are buying, continuously buying the mid-cap stocks, and also considering the current progress of monsoon, we focus more on stocks where we think even the failure of monsoon will have least impact. Example, in pharma sector, we continue to buy stocks like Lupin, Veith Lab, because the pharma faces almost elastic to the demand originating from the income. So even if there is a monsoon failure, they can manage. Plus, they continue to grow at 17% year on year on the domestic side, and plus the depreciation of rupee also will be positive. Similarly, we continue to buy mid-cap IT stocks. We think that there could be further consolidation in the mid-cap IT space, and therefore there could be possibility for upgradation in the PE ratio for these mid-cap ITs. So we continue to buy stocks like Persistent System in the mid-cap IT space. And then in FMCG, the stocks which are overstretched in terms of valuation, we continue to book profits and move that money into cash, so that after a week or so, after assessing the monsoon, one can use that cash to put back in the most convincing sectors.
You spoke about mid-cap IT stocks, Chokkalingam. What would be your preferred pick in the mid-cap IT space?
At present, we have been buying Persistent System and also Infinite Computer Solutions. These are the two stocks which we like very much, because almost zero debt, enough cash on the books, and quoting at anywhere from 6 to 8 PE. And they can definitely enjoy a PE of around 11, 12 at least. If you look at Patni Computer deal, which happened, the post that deal, the PE in fact has gone up beyond 12. So there's enough opportunity in this mid-cap space.
Chokkalingam, what about SBI? Do you think this quarter around and again we will see asset quality concerns only increase for SBI? Because there have been two brokerages who have downgraded the stock and have brought about the fact that perhaps this time around we are going to see asset quality pressures actually sustained for SBI.
Though it's the largest bank on asset quality, it is not comparable to the most efficient private banks like Yes Bank or Axis Bank. And we continue to sell the stock. Anytime it crosses 2200, we have been selling for last 6 months to 8 months. And we would advise continued selling of the stock, because we don't know what would be the extent of pain coming from the restructuring of assets. and in fact, FDI in aviation is also not happening. So there are a lot more individual accounts also would create fair amount of stress to its books. So therefore, I would advise continuous selling any price above 2200.
What about these power stocks like Tata Power on the back of the tariff hike in Delhi? Do you think the trend is that we could see more such tariff hikes, and does that will that augur well for the sector? What's your call on some of these stocks?
We continue to remain seller of this kind of power stocks for a couple of reasons. One, some of the companies are highly leveraged, and unless the interest rate cycle really gets reversed significantly, their net margin would be under pressure. And two, the power distribution companies, particularly the SEBs, are still in deep trouble. They are unable to pay back to the power distributors, power producers. So, and also the third reason is that if you look at in the last 8 months to 10 months, a lot of quality stocks without any debt issue or without any problem on top line growth, even those stocks have been hammered a lot. So therefore, when good quality stocks without any debt problem, with good quality of revenue growth available at attractive valuation, so why to look for these kind of power stocks where there are a lot of issues, apart from even the issues arising from Indonesia, where many companies had a great disappointment in terms of exporting coal from that country. So we continue to remain seller of these power stocks.